Hello everyone. So today we are going to look into leasing only. So we have already seen in our previous classes how actually we do the financial evaluation of lease, but those evaluation were based on those were actually mainly for the lessee, okay? Because in leasing you know that there are two parties now, দুটা party থাকে, এটা হৈছে lessor, other is the lessee. So the lessor is the owner of the asset. He is the owner who gives the asset, okay? The lessor is the owner of the asset, and this owner actually gives the asset on lease to the borrower. Lessor is the borrower. He is in requirement of the asset, but he do not possess the asset, so he takes the asset on lease from the lessor. So lessor gives the asset on lease to the lessee, so the asset is passed on, and for that the lessee gives some lease rental. Okay, he gives some remuneration which is known as the lease rental. So every month or every year he'll be paying some rental, for which he'll be getting the asset to use the asset. So we have two parties in the lease, that is the lessor and the lessee. So earlier we have seen the financial evaluation of lease from the lessee's point of view. So today we will look into the financial evaluation based on the lessor's point of view. Okay, lessor means he is the owner of the asset, who possesses the asset, who buys the asset and then gives it on lease. So from the lessor's point of view, how you are going to do the financial evaluation? Okay, when you are going to do the financial evaluation from the lessor's point of view, you have to see what the lessor is doing. Okay, what the lessor is doing, the lessor being the owner of the asset, he is obviously buying the asset. No, he will be buying the asset from market or from some dealer. So while buying the asset, he will be paying some money. So that is his initial investment which he was making in buying the asset. Once he has made that investment, after that he will be giving the asset on lease to the lessee. So after he buys the asset, this buying cost is obviously cost for him, which is the initial investment, you can say. And after that, when he will give the asset on lease to the lessee, then he will be getting the rental for it. So that is an income for him. Now since the lessor buys the asset, he is actually the owner of the asset. No, the lessor is the owner of the asset. So the lessor will also have the possession right of the asset. So when he is the owner of the asset, so he will be also getting the benefit of the depreciation. Okay, so he can charge the depreciation, he can show the depreciation as a cost, as well as he can get some tax benefit on that depreciation. So being the owner, he will be getting the treatment of depreciation with him. যোনটো তোমাৰ depreciation আহিব সেইখিনি সি তাৰ cost হিচাপে দেখাব পাৰিব, আৰু depreciationৰ পৰা যোনখিনি তোমাৰ tax benefit পাব, that also he can show in his accounts. Plus being the owner, at the end of the life of the asset, he can sell the asset to get some salvage value. So that salvage value will also give some cash flow to him at the end of the life of the asset. Alright, so being the owner, he will be having the rights of depreciation as well as the salvage value. And apart from that, he will have the initial investment cost, which he will be making, which he will be having to buy the asset, and he will also have he will be getting the lease rental from the lessee. So now we'll quickly look into the lessor's financial evaluation of your lease. For that, like your lessee's evaluation, for lessor's evaluation also, we mainly look at the cash flow. Okay, we see whether the cash flow from the leasing operation is having some positive cash flow or not. Means after the suppose the lease is for 5 years, so after 5 years the total cash flow in those 5 years, whether the present value of the cash flow is having some positive value or not. So if the cash flow comes out to be positive, if the present value of the cash flow comes out to be positive, you can say that the leasing is successful, or it can be beneficial for the lessor. So now we'll just quickly look into one of the examples. So just remember, we are doing it for the lessor's point of view. Okay, lessor's point of view. So from the lessor's viewpoint, whether leasing is going to be successful or whether leasing is going to be beneficial or not. Now for this, suppose for we have taken this simple example. Suppose your cost of machine or cost of the asset, suppose the cost of the machine is 15 lakhs rupees. Okay, rupees 15 lakhs is the cost of your asset. And suppose the salvage value after 5 years, suppose the salvage value is 1 lakh. Okay, it means the life of the asset is 5 years. You will be buying the asset, you will be giving the asset on lease for 5 years. After 5 years you will be selling the asset when you will be getting 1 lakh rupees. Then some additional information will be given. Suppose the tax rate which is applicable is, say it is 35%, and the depreciation is 25% on written down value method. Okay, so these are the basic information which is given, that the cost of the asset being 15 lakhs rupees, which will have a salvage value of 1 lakh rupees after 5 years, and the tax rate is applicable, which is applicable is 35%, and depreciation will be charged at 25% every year on written down value method. Now this asset which the lessor will have, okay, lessor is the owner of the asset, so he will be buying the asset with 15 lakhs rupees. So once he buys the asset, he can give the asset on lease. Okay, he will be giving the asset now on lease. So if he gives the asset on lease, then how much he will get? See, suppose the machine can be given on lease with annual rental of rupees 4,50,000. Okay, let this be paid in arrear. Okay, so annual rental, suppose on 4,50,000 rupees, the machine can be given on lease. Okay, this lessor who is having the asset of 15 lakhs, so he will be giving the asset on lease, and the rental he will be charging every year is, suppose, 4,50,000. Okay, this is the annual rental, and this will be paid in arrear. Arrear means at the end of every year he will be paying the, he will be getting the rent. Okay, he will be getting the rental, means he will be getting the first rental after 1 year at the end of the first year. He will be getting the second rental at the end of the second year. Okay, at the starting he will not get any rental, he will be getting the rental only at the end of every year. So you have to do the financial evaluation, and while doing the financial evaluation you will be requiring one more figure, which is, let me give that amount. Okay, the weighted average cost of fund of the lessor is 14%. What it means? It is the, see, when the lessor is giving the asset on lease, he will have to buy the asset. Okay, he is purchasing the asset of this 15 lakhs. So where from he is getting that 15 lakhs? He has some sources of funds, maybe his own money, or he is taking some loan, or he has some sources of money. Okay, so where from he is taking the money, he will be giving some return to that. If he is taking the money on loan, then he has to pay some interest. So this is the return which you have to give on his capital. So 14% is the cost of capital for the lessor. Alright, so the money which he is investing, for that he has to pay this 14% return or 14% interest. So this is the cost of capital of the lessor. This includes the overall cost of capital for the lessor. Okay, that can be equity, that can be debt, or anything. So whatever is the source, the total weighted average cost is this one. And this we are going to use it as the discounting rate for lessor's point of view evaluation. Whenever we will be evaluating lease from lessor's point of view, this particular rate, that is the weighted average cost of capital or the marginal cost of capital of the lessor, that will act as the discounting factor for the lease evaluation. Okay, now just you have to say whether the lease is going to be financially profitable or not. Okay, is it financially profitable? Is it financially profitable for the lessor to lease the machine? Okay, is it financially profitable for the lessor to lease the machine? So you have to do a financial analysis to say whether the lessor can give the asset on lease or not, whether that will be profitable or not. So with this information you can do the evaluation. That's why what are the information those are given to you. The cost of the asset which is given, it is 15 lakhs rupees. After 5 years you will get 1 lakh by selling the asset. Okay, that is the salvage value of the asset is 1 lakh rupees. Tax rate 35% and depreciation is 25%. The machine will actually give a lease rental of 4,50,000, which will be the annual income for the lessor. Lessor will get this amount. So this is the annual income for the lessor. Weighted average cost of fund for the lessor is 14%. This is the cost of capital for lessor, which will be used as the discounting rate, and you just have to say whether it will be profitable to lease the asset or not. Okay, from the lessor's point of view, whether it will be profitable to give the asset on lease or not. So to solve this problem, you have to first find the, see, we have already said it, from the lessor's point of view, to do the evaluation you will be finding the cash flow after tax. Okay, what you have to do, you have to find the cash flow after tax. Okay, you have to find the cash flow after tax for the lessor. Now what will be the cash flow after tax? See, cash flow after tax, what will be it? So for the lessor, what is his source of income from this lease agreement? Okay, from this lease transaction, what is going to be the source of income for him? The only source of income which we will be having is this one, the lease rental of 4,50,000. So this lease rental will be his source of income. Lease rental will be there. Now when this lease rental will be there, after that he has to pay some expenses also. So what are the expenses he will be having? So since the lessor is the owner of the asset, he will be having the cost of depreciation. He will be having the depreciation cost. So this depreciation cost, whatever is the lease rental 4,50,000, from this the depreciation has to be subtracted to get the actual earnings for the lessor. So we will be deducting the depreciation, then you will be getting the earnings before tax. Once you get the earnings before tax, then you will be paying the tax. After you pay the tax, you will get the what? Earnings after tax. Then after the earnings after tax, you have to find the cash flow after tax. What is cash flow after tax? Cash flow after tax is earnings after tax plus any other non-cash expenses which you have shown. So here this depreciation is a non-cash expenses, because for depreciation you are not paying anything, you are just decreasing the book value of the asset. So with this CAT you have to add back the depreciation to get this cash flow after tax. Alright, so this you already know how to find the CFAT. So for CFAT, for the cash flow after tax, you will be having the earnings. From that you will be subtracting the depreciation, you will be getting the earnings before tax, then you will pay the tax to get the after tax profit. Then from that you add back the depreciation to get the cash flow after tax. So this much thing we are going to do it right now, and to do this you have to make the depreciation schedule first. Okay, so first we'll make the depreciation schedule and then we'll be finding the cash flow. So let me quickly make the depreciation schedule. Okay, so I'll just make the depreciation schedule. So you'll have the year, the life of the asset is 5 years. So you'll have 1, 2, 3, 4 and 5 years. Then value of asset at the beginning of the year. Then you'll have the depreciation for the year, which is 25%. Then you'll have the value of the asset at the end of the year. Okay, on the first year at the starting, the value of the asset is the total cost of asset, which is 15 lakhs. So on this 15 lakhs for the first year, 25% depreciation, 25% will be 3,75,000. So after that the value of the asset at the end will be how much? 15 lakhs minus 3,75,000. 11,25,000. That will be the opening balance for a second year. Now 25% on this amount, okay, 25% of this one, which will be 281,250 depreciation, and the closing will be this minus this, that will be 84,3750. Similarly for third year you will be having, I'm going a little fast because you know all these things. So third year depreciation will be 210,937 and the closing value will be 632,813. So you'll get this kind of depreciation schedule. Okay, if you give it an 25% depreciation, these are going to be the numbers you will be getting. So this middle column is the amount of depreciation which you are showing every year for the lessor. So lessor will be having this much expenditure as depreciation every year. Alright, so this is our depreciation schedule. Now after this is made, you can go for preparing the cash flow for the lessor. So let us make the cash flow also. Okay, so we'll be making the cash flow statement. So same here, you will be having the year. Okay, so you'll be having 5 years. So we have this 5 years. Then you'll be starting with the income of the lessor. The income of the lessor in this case will be what? You will be getting the lease rental every year. So the lease rental will be there, lease rental. You'll get the lease rental every year. Okay, from this lease rental, which is the income, you have to subtract the depreciation. You'll be subtracting the depreciation every year. Whenever you will subtract the depreciation, okay, let me give some number to these columns. So this is column 1, this is column 2, this is column 3. Okay, so you'll be subtracting the depreciation from the lease rental, which will give you the earnings before tax. Okay, earnings before tax. What is earnings before tax? That is column 4, which is equal to 2 minus 3. Lease rental minus depreciation. Then you have to pay the taxes. After you pay the tax, you will be getting the earnings after tax. Earnings after tax. How you find the earnings after tax? It is very simple. Earnings before tax into what? Into 1 minus tax rate. Okay, into 1 minus tax rate. Tax rate is 35%, so into 1 minus 0.35. So EBT into 1 minus 0.35, that will give the earnings after tax. With the earnings after tax, we will be adding back the depreciation to get the cash flow after tax. Okay, cash flow after tax, how you get it? Simple. With the earnings after tax, you add the depreciation, 5 plus 3. Okay. Okay, this is EAT plus depreciation. So this will be your cash flow after tax. After that, you have to find the present value. So you'll be multiplying them with the present value interest factor. At what percent you will multiply these factors? You have to find this factor at the weighted average cost of capital of the lessor. So for our case, the weighted average cost of capital for a lessor is given as 14%. So you will be finding the present value factors from the table at 14%. Then you will multiply the CFAT with the present value factors to get the present value of CFAT. Okay, that will be what? That will be column 6 into 7. So this way we will be finding the cash flow after tax and the present value. So we'll just quickly put the amount here. Lease rental, see, lease rental for the first year, in fact lease rental is given as 4,50,000 every year. So for all these 5 years the lease rental is going to be 4,50,000. Okay, the same rental you will be having for all the 5 years, 4,50,000. Now depreciation, yearly depreciation you have calculated in your depreciation schedule. So from this table you just put the figures in that table. So first year it is 3,75,000. Again second year it was how much? It was 281,250. Third year it was 2,10937. Already we have calculated, no? Then 1,58203. And in the fifth year it is 1,18652. So these are our depreciation figures. Then you will be finding the earnings before tax. This will be what? Lease rental minus depreciation. So 4,50,000 minus 3,75,000. Okay, so amount will be how much? It will be 75,000. Then second year 4,50,000 minus 2,81,250. It will be 168,750. Similarly, we will find all the values. Okay, so these are our earnings before tax. Earnings after tax will be earnings before tax into 1 minus tax rate. Tax rate is given as 35% for us. So T is 0.35. No, tax rate 35% means T is 0.35. So you have to multiply 1 minus 0.35. 1 minus 0.35 will be how much? 1 minus T will be 0.65. So you have to multiply this 0.65 with the EBT to get the EAT. EAT will be EBT into 1 minus T, that is 0.65. So 75,000 into 0.65. It will be 48,750. Similarly 168,750 into 0.65. Okay, so similarly we are doing all this. So these are our earnings after tax. Then cash flow after tax will be earnings after tax plus depreciation. You have to add back this depreciation with the EAT. So 375,000 plus 48,750. 423,750. Similarly, this one will be 281,250 plus 109,687. So we'll complete all these 5 years. Alright, so these are our cash flow after tax. Then we'll be finding the present value factor at the cost of overall cost of capital for the lessor is 14%. So at 14% you'll be finding the present value factors. So you need only one discounting rate when you are doing it for the lessor's point of view, and that discounting rate is what? It is at the lessor's overall cost of capital. So this is given as 14% in this case. So at 14% from the PV table we'll be finding the numbers. These are table figures, okay, at 14% present value table. So we'll multiply the cash flow after tax with the PV factor to get the present value of the CFAT. So I'll multiply this with this. That will give Similarly, this into this will be so this will be the present value of the cash flow after tax. Okay, so for the 5 years, these are the cash flow after tax which we are getting by considering the lease rental and the depreciation. So you add all them, you find the total, it will be I think 1298832. okay, the total will be this one. This is the present value of the cash flow after tax. So let me write it here. Total PV of cash flow after tax. Okay, this is cash inflow, right? Remember, this is cash inflow. Why it is cash inflow? Because lease rental is the amount of cash you are getting. Then after that you are considering all this tax and depreciation. Finally, this is the amount which you are having in hand. So this is the amount. This is the present value of the cash flow which the lessor is getting from the lessee. So this is the present value of the cash inflow. Now along with this, see, you'll also have some other sources of cash flow also, because the lessor is the owner of the asset. So being the owner of the asset, at the end of the life of the lease, that is after 5 years, we will be selling the asset to get some salvage value. So you have to consider that salvage value also. So the present value of salvage value, present value of the salvage value of the asset, that will be how much? Salvage value is given as 1 lakh rupees. Okay, it is 1 lakh rupees salvage value. So you have to consider the present value. Present value means after 5 years you will be getting this salvage. So after 5 years the present value factor is 0.519. No, discounting rate will be same, that is 14%. It is the overall cost for the lessor. So 0.519. So if you multiply it, it will be how much? 51,900. okay, so this is the present value of the salvage value of the machine. So whenever you add them with the first inflow, whenever you will add this salvage, you will be getting this one, no, 1350732, 13,15,732. okay, this is the total PV of cash inflow. See, at this stage you can also consider one more thing, that is the, because that is the short-term capital loss which the lessor is having for selling the asset, because he is selling the asset on 1 lakh rupees, but the actual value of the asset after 5 years, the book value was 3,55,958. So this 3,55,958 asset he is selling for 1 lakh. So there is a loss of 2,55,958 rupees. So that is a capital loss for him. And whenever this capital loss is there, he will be getting some tax shielding for that. Okay, he will be having some tax benefit for that. So that tax benefit on the capital loss, we are ignoring them right now, because we are at the basic stage. So we are ignoring those capital gains and losses. So we are also ignoring the tax shielding on the capital losses. So ignoring those things, the total PV of the cash inflow comes out to be this one. Means if the lessor gives the asset on lease, he will be getting this much amount. The present value of the cash which you will be getting, that will be this much. So from this you will be subtracting the initial outlay of the asset, that is the initial cost of the asset. So you just subtract the cost of the asset, that is the cost of the machine. The cost of the machine was 15 lakhs, no, it was 15 lakhs rupees. So when you subtract the cost of the machine, the difference comes out to be, see, it is negative 13 lakhs 50,000 minus 15 lakhs. So it will be negative. So this is a negative figure which you are getting. So this negative figure is the net present value. You can say this is the net present value of the leasing. Okay, so if the lessor gives the asset on lease under these conditions, then there is a negative NPV of 1,49,268 rupees. So since the NPV is negative, so it is not financially profitable for the lessor to give the asset on lease. Okay, so the question was asking you whether it will be financially viable for the lessor to give the asset on lease, and the answer is actually no. So you cannot suggest the lessor should give the asset on lease, because if he is going to give the asset on lease, then there is a negative NPV, which means he will be having shortage of money if he is going to give the asset on lease. So it is a condition of loss for him. So whenever the NPV comes out to be negative, the answer will be that it is not feasible for the lessor to give the asset on lease. But if this NPV comes out to be a positive one, then you can say that it is beneficial for the lessor to give the asset on lease. All right, so this is how you'll be doing the financial evaluation from the lessor's point of view. So you just have a quick look how you have done the entire thing. Okay, what you have done, so what you have done is this, no? So you'll be looking at the cost of the asset first. It is 15 lakhs. Then you know the salvage value 1 lakh rupees. Then these rates are given. You know the lease rental, which is 4,50,000. So from this lease rental, which is the only source of earnings for the lessor, you have to deduct the depreciation, because being the owner of the lessor, he will be having the claims of depreciation as well as the salvage value. So from this 4,50,000, you will be deducting the depreciation. That will give the earnings before tax for the lessor. Then you will be paying the taxes. After paying the tax, you will get the earnings after tax. With that earnings after tax, you will add back the depreciation to get the cash flow after tax. So that way we have done the entire sum, and in this sum you just see we make the cash flow table. For that, earlier we have made the depreciation table, so you all know how to prepare this depreciation. Then after you prepare the depreciation, you make this cash flow table, and here you will be having all these figures: lease rental, depreciation, EBT you will be finding. Then you will be paying the taxes to get the EAT. After that, you will be having the cash flow after tax by adding the depreciation to the EAT. All right, then you will be discounting them at what? At the overall cost of capital for the lessor. So after discounting, you will be getting the present values. Sum up all the present values, you will get the total figure. Then with that, you add the present value of the salvage. So that will give the total cash inflow for the lessor. From that, you subtract the cost of the machine, cost of the asset. This will give the NPV for the entire lease proposal. So for this lease proposal, the NPV comes out to be negative, which means the lease is not financially viable for the lessor's point of view. All right, so remember, this is for lessor. Okay, lessor means he is the owner of the asset and he will be giving the asset on lease. So you are finding whether this proposal for giving the asset on lease is financially feasible or not. All right, hope you got understand. Thank you.